For our COBT viewers and listeners, it's Maynard and Mike with something super special. We've had Neil Mehta and members of his team before at Goldman Sachs, but we've never quite done it like this. And what I mean by that is it's plus or minus the end of earnings season for energy companies. And this morning we've got Neil Mehta and Carly Davenport from his team to talk about what we learned across the broad expanse of energy, power, utilities, et cetera, companies reporting this past season. I've got my friend Mike Bradley here also to give us some thoughts on earnings, but let me just pause and say, Neil and Carly, we appreciate you guys and Goldman so much, so thank you for joining.
Thank you. You have the best podcast on energy out there, and it's a great opportunity for us to spend some time with you, Maynard and Mike.
Well, you're a good man. Now, Neil, it's your birthday. We're supposed to be giving you presents, not you the other way around. I mean, that comment was about as good a present as we'll get all year. All right, Mike, before we jump in with Neil and Carly, what's your take on what's happening right now, or anything you'd add?
Maynard, I would say, we haven't said this in quite a while, but volatility is really high. Just looking today, the Dow Jones was down about 850 points at the session lows, rebounded to down only about 150 points, and at the end of the day, it ended down, maybe even in the last half hour of the day, it ended down roughly 675 points. So just a lot of volatility right here. You know, if we think about the bond market right now, we haven't talked about that in a while, but yields have been plunging right now. The 10-year bonds around 4.2%. That's the lowest of Trump's presidency. And obviously what the bond market is concerned is what these tariffs are going to mean for U.S. economic growth. And so right now it looks like the bond market is dialing in 3 rate cuts this year, and that's up from 2 rate cuts probably from just a couple of weeks ago. Bottom line, I think most people thought Trump at the last minute would back away from these Canadian, Chinese, and Mexican tariffs, and he did not. And so the market's trying to deal with that right now. As far as broader equity markets, the S&P 500 is technically oversold. I mean, tons of negativity is dialed into the market, and sentiment is soured quite significantly. How much has it been over the last week or so? The S&P is down about 3%, and that's obviously due to concerns that companies are going to have to absorb some of these tariffs. They're not going to have to pass them along. That's going to mean some margin compression, and so the market's trying to deal with that right now. The one thing I'd say is the S&P 500, from a technical market standpoint, is sitting right on top of its 200-day moving average. If it breaks through that, then the market could go much lower, and we're talking about 5,500 is the next trading support for the S&P 500. So something we're really watching closely here. As far as crude oil, you know, OPEC essentially threw a wrench into the market this week. You know, oil price, WTI, is around $68 a barrel, and that's trading near the low end of its last 6 months trading range. And obviously the reason why this week is that OPEC signaled that they're going to increase production in April, roughly 135,000 barrels a day, which is really nothing in a 105 million day market, but consensus wasn't expecting that. Most people expected they were going to push those production increases into the second half of the year. They didn't. The market's reacting to that, and this is going to be the first time in 3 years that they're actually looking to increase production. So global S&D right now is already in surplus. We estimate it's around 500,000 barrels in surplus. This is only going to add to that surplus. And it makes you wonder, what is OPEC thinking? Do they think the market is stable here? Do they think Iranian barrels are going to be coming out of the market? Something to think about, because, you know, on the face of it, you know, investors are not very enthusiastic about what OPEC is doing at this point in time. Now, as far as energy equities go, you know, I'd say that the key word, and something we want to talk to the Goldman analysts today about, is just market dispersion, performance dispersion. If you look at energy year to date, you've got, you know, subsectors like E&Ps and oil services down 6 to 8%, but you have like midstream up 5 to 6%. But within those subsectors, you have anywhere from a negative 30% move to a positive 20% move, and that's a lot of dispersion. We have not seen that in quite a while, and it really tells me that, you know, investors are really being picky on the stocks that they're investing in, and if you don't, you know, meet expectations, you're going to be severely hurt here, and that's what's happened. As far as Q4 developments, I'd say late in the season we had a lot of gassy E&Ps report Q4 results. They gave guidance, they gave their capital guidance, and I think what we saw here in the last week or so is some of these gassy E&Ps have signaled that they're looking to pick up rigs in the second half to increase their productive capacity for gas in the second half going into 2026. And I think the market is kind of right now, I don't know if they're giving them the benefit of doubt at this point in time. All I would say is a 12-month strip right now is 475 in M. But if you look at the winter months, we're talking November, December, January, in March, all the future contracts in those months are above $5 an M. So it's a pretty interesting market. Some gas E&Ps have said what they're going to do. We'll see if there's going to be follow through in the next 3 months when we see Q1 reports and see if more people will have some updates like this. And the last thing we'd say is we've been watching, not only OPEC, but Aramco. Aramco reported earnings today, and they were pretty good. The thing we were looking at is their base dividend. They raised their base dividend by 4.2% today, but they announced that dividend distributions in totality for 2025 are expected to be around $85 billion. And that's down from roughly $125 billion in 2024. And that's because the performance-linked distributions are going to be a lot lower this year than they were last year. And so what does that mean? That means that there's going to be a big budget cut for Saudi coming in. So when we think about that and we think about what OPEC is doing, increasing production, lower oil prices, Saudi government's going to getting less money. We got to wonder, what do they see that we don't see? Maybe it's Iranian barrels being pulled off the market and they feel like they're going to have those. So we're really looking forward to talking to Neil today and Carly today, not only about the dispersion of markets, but what they see in electricity markets, how they see the global S&D into 2025. So with that, Maynard, we'll hand it back to you.
All right, awesome. Well, guys, let's jump in. I didn't do as good a job as I should have introducing you two, but Neil, you're the head of North American Natural Resources Equity Research. Carly, your focus within that is utilities. You have experience in refining, the integrateds. Neil, you're really covering, of course, the upstream companies, but also the large caps and the big integrateds, and you see really everything that's happening, both of you at Goldman Sachs and Research. So again, we're delighted to have you. As we think about reflecting on earnings, Mike hit a couple of the themes, but as you think about this earnings season, Neil, what's just the first thing that just jumps out at you about what happened here?
Yeah, thanks so much again, Maynard, for the opportunity. I'll start on the oil and gas side, and I'm going to transition it over to Carly to talk about the power side. But one thing you're going to hear from both of us today is this is less of a market where it's about being directional on the sector and more of a market which is about stock picking and dispersion. So there's a lot of idiosyncratic dislocations. And so if you look at the leaderboard this year, the stocks that are outperforming versus the stocks that are underperforming by group, you see real spreads, Maynard. And, the spreads could be 10, 15%. We're a couple weeks into the year, and we can explain those spreads based on operational execution, earnings execution, how the market feels about how you're allocating capital, and quality of management. And in a range-bound commodity and price environment, and the Goldman view is 70 to 85 Brent, and call it plus minus 375 Henry Hub. So we're living within both of those ranges. What matters a lot is idiosyncratic drivers in spread. So to me, we came into the year with that view that it's micro over macro, and earnings season absolutely affirmed that view. And we can talk about some high-level thoughts by subsector. One good example is in Canada, a space that I know you've spent a lot of time spent on the oil sands space, and we've generally been constructive. We got tariffs, which are certainly a huge focus for investors. But underneath that macro variable, from a micro perspective, you've had companies like Suncor, which have outperformed companies like Cenovus by 15% this year, right? Cenovus missed on their downstream business. Suncor continues to crush it on their upstream business. And you had a very significant spread reflected in year-to-date performance. You saw a little bit of it at our conference in January where the market anticipated it, but you got the follow through on the way we thought about earnings. Super majors are another great example of that. We've seen big spreads this year with BP under activist pressure and taking steps to try to right the ship after multiple years of mistakes in the way that they've allocated capital and operating, performing very well this year. Chevron also bringing in Tengiz, bringing in Gulf of Mexico, getting closer to potentially solving its inventory issues, translating into outperformance versus some of the stalwarts of the industry like ExxonMobil. The gas side has been super interesting, where the market has been rewarding the companies that have been showing a little bit more discipline in the eyes of the market. So think of Antero and EQT, and being a little bit more skeptical of the companies who are adding back supply, not because they're wrong to do it. The forward curve is $4, but because when you're adding back supply, there's inherent risks in the story. And so you've seen those spreads between the Anteros and the EQTs relative to the expands of the world. Refining is probably the most extreme example, Maynard, of where we've seen those spreads, right? Because you've had companies like Marathon Petroleum, Phillips 66 up on average 10% this year. You've had small cap refiners down on average 11%. So that's a 21% spread. Again, we're a couple weeks into the year. And so I think the market is rewarding scale in refining. And lastly, oil E&P. There continues to be a preference for onshore versus offshore. So the poster child for that would be like a Devon, which has done a good job of operating, versus some of these offshore names, including Apache and Murphy and Cosmos, where you're seeing the market a little bit more skeptical, despite the deregulation that comes with the Trump administration about the risks associated with operating offshore, which is true. And operating in offshore can be a challenging space. So across each of these ecosystems, we haven't even talked about service or utilities. I asked to turn it over to Carly, but you're seeing real dispersion, which from a stock selection standpoint and as a stock picker, which is my job, is very fulfilling. We recognize this market will switch from micro to macro at some point, and we want to be there when that inflects. But in the meantime, it means we have to have our models tight and we keep our pulse on some of the moving pieces at the company level over the macro at this moment.
That's an awesome lead in. Carly, let me get you in here before we start peppering you guys with some questions after that meaty throw in you gave us there, Neil. There's lots to grab onto there. But Carly, welcome. Glad to have you.
Yeah, thanks so much for having me on. I think a lot of similar kind of strains to Neil's comments read across to the utility space as well. As we think about, the last year, really, investors were looking for stocks among the power and utility space that had just the most leverage to this broad thematic in terms of AI and power demand. But to Neil's point, when I look back on this past earnings season, that high level, just having the exposure has really proven not to be enough to get the stocks moving through this earnings season. We've seen much more of a focus on execution and on really translating those opportunities into earnings growth. And I think really based on our conversations, that's what investors are looking for. They're looking for the companies which can actually translate that opportunity on load growth and capital investment, which we know is needed across the power infrastructure, and actually translating that through to stronger rate base and stronger earnings growth. I think we're looking for, the companies that can actually explicitly shift their earnings growth guidance ranges. Most utilities are in this 5 to 7 or 6 to 8% range, looking to see that kind of 100 basis point move higher in that earnings growth range. And when that's not coming through, the stocks have underperformed, throughout earnings season. If we think about, some of the dispersion that we've seen across the space, we look back to even third quarter where Excel updated their capital plan, their earnings growth guidance, and we saw that translation from increased load growth, increased rate base growth to driving a change in the earnings growth guidance. And conversely, this quarter, there were a couple of stocks, whether that was Sempra or it was First Energy, that took up their CapEx, but they rebased their 2025 earnings lower. And those stocks have underperformed on the back of that announcement. And so I think to Neil's point, that dispersion that we've seen across our utilities coverage year to date, I think has been much wider than in many other periods of time where you have kind of a view on the sector or a specific theme. If we look across our coverage, the worst performing stock year to date is down about 32%, best performers up 17%. And I think when we try to parse those two out, the best performers are those stocks that are pretty purely regulated. They have less operational or execution related risk, and they have a quieter regulatory calendar for the year, where investors can get confident that we are seeing an inflection in earnings growth, but it is low risk growth. So there's still a focus on some of those defensive characteristics that we've seen for utilities over time. And on the other side, the worst performers have been stocks that have more idiosyncratic issues or exposure to themes that have been more challenging, whether that's wildfire risk, its execution issues on earnings, or its regulatory or policy type overhangs. So I think that Neil's comments have been true, whether it's on the traditional energy side or across the utility space as well.
So Carly, I'm curious, because power has been the flavor of the day in so many ways for a while now. How do you sort through, there's so many announcements that come out about power, right? And how do you sort through the ones that are have immediate or more kind of real implications versus the ones where, it's interesting, but it's not clear when it's going to happen? Like, is that do you spend a lot of time on that issue in particular?
Absolutely. I mean, power demand has been, to your point, the topic across the space over the last year or so. And I think it comes down to, again, that translation of sort of going from just who has the exposure to really where are we starting to see this show up in capital investment plans and see this showing up in earnings. So utilities always think, in these 5-year kind of planning periods. Of course, they're thinking longer term, but they give us these 5-year capital plans. So when are we seeing actually investments rolling in years, maybe 1, 2, and 3 of the plan, where you can start to see the earnings from some of these transactions that are, coming through in maybe 2026, 2027 versus something that's much longer dated coming in 2029. So the way that we try to look at it is one with a regional overlay. So I think when we look across the US, there's certain pockets that we're expecting to see more significant load growth than others. We think about the Southeast and places like the Georgia market, where Southern has talked about Georgia Power load growth of, call it 12% over the next couple of years. We think about places like Texas and in ERCOT, where we're seeing massive increases to load, and companies like Encore that operate in Texas are seeing potential doubling or tripling in their peak load over the next decade. So I think we're looking to see where just these announcements we can actually take that down to concrete capital investments, or we can take that into earnings growth and see where we're actually seeing those inflection points, and overlaying it with the equities where maybe that's not reflected in valuation or performance. These stocks haven't quite moved yet as much as some of the others that may be exposed to this theme.
Well, question for both of you: if someone is calling, so if an investor is saying, I really want exposure to power, talking to me about the power menu. Carly, you do utilities. Neil, you've got service, and you've got infrastructure oriented things, and you've got E&Ps that could somehow be levered to that. Like, how do you direct people to the power menu at Goldman?
Yeah, I'm happy to start. So I think we from the power and utility side, we look at it from a couple of different verticals. One is just on the power generation side. So from that perspective, we like companies like NextEra that have the ability to build generation infrastructure, and that I think uniquely for NextEra, a lot of that is renewables. And when we think about the priorities for data center and other large load customers, the number one piece is time to market. And we can build renewables right now quite a bit faster than you can build a new gas plant if you're deciding today that you want to build a new power plant, because the queues to get a new gas turbine have become so elongated that if you're putting in a request today, you're likely not getting anything until the late 2028 or potentially even 2029 timeframe. But if we think about what a company like NextEra can do on the renewable side, they can get a wind facility up and running in 12 months, a storage facility up and running in 15 months, and a solar facility up and running in 18 months. And NextEra has 150 gigawatts of interconnection queue capacity already. So those projects should be able to move to market pretty quickly. And we think that's an advantage in the near term as we contend with these supply chain constraints on the gas side, which we do view as an important baseload source of power for these large load customers. But just as we try to bridge to when we can get more of that online, NextEra would be a company we think can benefit from the ability to build more renewable power projects. And then we think about the regulated side, and we look across the utilities that have vertically integrated exposure, which is where we have a bit of a preference, because as we think about the opportunity set for capital investment, having the ability to build generation in addition to the wires infrastructure just gives you another bite at the apple to help support rate-based growth and earnings growth going forward. So we overlay that vertically integrated exposure with, again, those regions that we, believe have some of these robust load growth opportunities. So companies like Southern in the Southeast that can build generation, transmission, and distribution to support load growth. Companies like Excel, that have data center contracts in place with companies like Meta in Minnesota, and other opportunities in Colorado. And then they've also got the leverage to electrification of the Permian Basin in their Texas and New Mexico business. Companies like American Electric Power, that operate in PJM and Texas and have over 20 gigawatts of backlog just of data center load, across their 5-year kind of planning period or out to 2030. Those are kind of a few of the vertically integrated utilities that we've been highlighting that have the opportunity to build transmission, generation, and distribution to support this incredible load growth that we expect to see, where we're forecasting about a 2.5% U.S. power demand CAGR through 2030. And we think there's a lot of investment, whether that's on the generation side or the wire side, that's going to be needed to support that. But that's just the power and utilities piece. But Neil, do you want to chime in on your side?
Yeah, it's a theme that permeates throughout all of natural resources. So when, Carly and I talk about the second derivative of this power view, which deep seek or not deep seek, we model efficiencies that are very significant, but we still have a 2.5% power CAGR between now and the end of the decade, which hopefully Carly get a chance to unpack how we model efficiency. That's still a really robust number. When Arjun Murthy from Veriton hired me at Goldman 18 years ago as a utilities guy, one of the things we talked about was how we had to dim the lights on power demand forecast. And we didn't expect to see power demand growth for the foreseeable future. Now to have 2 to 3% power load growth, which is real, which is showing up in the numbers right now, I think makes it for an interesting environment for a lot of stocks across the ecosystem. And so services is in the center of that, Maynard. So you think about something like the specialty contractors. In the next 5 years, Carly has utilities CapEx plus minus 40% higher than the last 5 years. And those are big numbers. And so you take a company like Quanta or MasTec or MYR Group, all those companies have come under pressure this year in the unwinding of the power theme. But even if there wasn't AI in data centers, you would still see very robust load growth because of electric vehicles, because industrialization of the US, and underlying demographics in certain regions that would suggest that we need to spend a lot more. Plus, we've got a utility grid that was largely designed in its modern iteration in the 1970s and 1980s that needs to be upgraded. And we've got to weather this storm against disruptive forces of climate change and a very unpredictable Mother Nature. So we need to spend a ton more. And so those specialty contractors are the construction companies that will be responsible for the transmission and distribution system that's going to be so necessary to meet that incremental load, but also just keeping the lights on, which is a lot harder to do in 2025 than it was a couple of years ago. And another good example would be a Baker Hughes. Power demand as a theme is not just an American theme, it is a global theme. One of the companies that is going to enable a lot of that generation would be Baker Hughes, partly through some of the smaller turbines that they sell into things like global data centers, but partly through LNG, where we still see a robust build of new LNG capacity here over the next couple of years. And then the last one, Maynard, would be nuclear. Again, this Cameco has been under a lot of pressure this year as a stock as a result of the unwind of the power theme, but it's still fundamentally a theme that we really believe in globally, in the need for new uranium, the need for new nuclear capacity, and that creates an opportunity as well. So Baker Hughes, Cameco, and then these specialty contractors like Quanta Services. And if you liked them 20% ago, we always say on our team, you should like them 20% lower unless something fundamentally has changed in the thesis, which we have to unpack, and we're going to continue to watch efficiency. But Carly's done some unbelievable modeling that has given me confidence, at least, that power demand and utility spend is a theme that's got some resiliency.
There's so much in there, and I got to get Mike in. He's chomping at the bit here. But are you guys? You mentioned this, Neil, the way in which something happens in the power space, or something that happens in the macro power theme, and then it can rip through some stocks. And now we have this connectivity between tech and power, and the broader classic energy space. Arjun jokes, this is the penalty for energy now being part of the cool kids, that when the cool kids trade off, you're going to trade with them. But what do you think about that interconnectedness? Does it mean you talk to different types of investors, for instance, tech investors, et cetera, who want to understand that whole complex? Like, how has it changed your world, that interconnection?
It's brought the generalists back in, right? And I think that's the piece that we, as 3% to 4% of the S&P as energy, is generally, the price action is largely defined by the specialist investor who looks at Suncor versus Cenovus and says, Suncor deserves to have outperformed Cenovus by 15% this year because of better execution. That's how the price determination for the specialists will work in a sector. But when generalists come in, the other that power of that investor who manages trillions and trillions of capital in technology, they take just a little bit of that and they put that into our sector, whether that's utilities or energy. It can create major disruptions in the way we think about valuation. And so, unanchoring to the historical ranges that we typically think about. And so we saw that manifest itself on that DeepSeek Monday when you had EQT trading down 10%. EQT is an Appalachia gas company. You think of it as generally disconnected from the rest of the world and barely has enough pipe to get out of basin. And now all of a sudden, some headlines around some efficiency gains in China drove EQT to trade down 10%. And that was a manifestation of the incremental investor who moved EQT from 40 to 55 was more of a generalist investor. And for them, that was a thesis changer. Now, the opportunity then came to the specialist to say, hey, they took the stock from 55 to 48. Is this an interesting opportunity? Because we like it for the value of Equitrans, because we like it because of its low cost position, the ultimate opportunity to return capital to shareholders, and the LNG upside. And so if one investor sold it because efficiency around data centers makes the case for $5 less interesting, then the specialists should be on the other side and say, well, we liked it because we believe in 375 Henry Hub, and take the other side of that trade. And I think that transition is tough and create volatility, but I think it will create opportunities on the other side of that trade.
And Neil, just sticking on this natural gas theme, I know in our lead-in today we talked about some E&Ps, natural gas E&Ps, and Q4 actually announcing rig additions. We have not seen that in years, to be honest with you. Scheduled to come on in the second half, for productive capacity in 2026, and something fairly new. And you said it earlier. There is some dispersion in the performance of these names. Are not being rewarded for that yet because of capital discipline and return of capital and stuff like that. So we'll see over time how that proves out. I guess my question would be, this is probably the best setup in gas that we've seen in the last 2 or 3 years. You obviously talked about 375 normalized that you guys have for your gas right now, which kind of is around, break even for a lot of companies, to be honest with you. I guess my question is, we're seeing substantial amount of demand, be it, electricity growth, be it onshoring, be it LNG, but we're also seeing the space has been consolidated as well. You're having more capital discipline on the supply side. So maybe take us thinking over the next 12, 18, 24 months, instead of just this cyclical aspect of natural gas, maybe talk a little bit at sort of the secular aspect. I hate saying that in a commodity world, but just the demand is going to be exponential and the supply is going to be constrained because of Wall Street. Maybe talk about some of those dynamics and maybe what people are grasping onto right now, what people are maybe missing in these companies.
Yeah, and Mike, because we've all been doing it a long time, being bullish on natural gas is hard, right? Because of our own biases. Because, in my career, I've seen natural gas double in terms of demand. And I came in when gas was at its higher watermark of $14, and last year we printed 2 MMBTU. So, there's the challenge of translating strong demand into a higher gas pricing is always tricky, right? And especially because we had a shale revolution in between and the unbelievable capacity of the American engineer to make this industry better, which is why I'm a little skeptical about taking that mid-cycle price above 375, even though Haynesville break-evens would suggest that we should, because I have a feeling these companies will find ways to take costs out of their business, become more efficient, find ways to drive longer laterals, and improve completion designs as well to try to continue to move that break even lower than what would be implied by our models. That said, 375 plus still sounds a heck of a lot better than the $2 we printed last year. And the stocks are not expensive, especially after the pullback around DeepSeek from these levels. And so part of the reason we do have a buy rating on EQT and Expand and Coterra. In terms of the way we think about it, the demand profile between now and 2030 is really robust. You've got 11, 12 Bs coming from LNG in that period of time. Capacity might be higher. We might have to throttle back utilization because the global gas market's going to get oversupplied. So let's call it 11. Then Carly and John Mackay from our team on the midstream side estimate about 4 Bs of incremental demand related to AI and data centers. Gets you to 15. Then you think about Mexico exports, industrial, and underlying power demand. Let's call that another 4. So we got to solve for 19 Bs of supply. We can get a couple Bs out of the Marcellus, a couple Bs out of the Mid-Con. You will certainly have good associated gas supply out of the Permian. We do about 2 Bs every 18 months. And now we have to price the Haynesville. And we're going to need Haynesville ultimately to be the marginal unit of growth. And then the question is, what does Jerry Jones at Comstock need in order to earn a reasonable rate of return? And how much discipline is there going to be out of the producers? And barring the same technological change that we saw with the shale revolution, I am more optimistic this time that stronger demand will translate into better price. And so the contango in the curve makes sense. Now, as an equity-related investor, I think we should always be conservative in the way that we price things. So even if the right tail versus the left tail, the 375 is clearly skewed to the right, I think the market should be conservative in the way that they price it, which is why we want to value the stocks off at 375. Now, the one bear case to counter, let's say, our 375 valuation that we need to take into account is the global gas market. And we do have a ton of supply coming on in Qatar. And the U.S. is going to add a lot of supply into this market. And we'll see what happens with Russia's supply and what all that means. So it wouldn't be surprising to me to see global gas, which is at $14 right now, move down to $8. And then you think about transport arbs. I do think that will provide a cap of how high we can go as a U.S. gas producer, which is, again, backs us into 375. But the demand story looks real. The supply story looks pretty good in the U.S. So there's reasons for cautious optimism. But having lived the 14-2 experience, I'm gonna model this stuff with a degree of conservatism.
Maybe Carly, just to jump back to something you were touching on, because I was thinking about this. You have this long-term macro study that suggests 2.5% CAGR per year in power. And then Neil just went through how much incremental gas demand there could be from all those sources. And then you start thinking about building gas plants, and you just always hear about turbines. And sometimes the number is 4 years, and sometimes the number is 6 years. But you just generally hear this pinch point in getting turbines. Can you talk about that and why that is, and the extent of it? Is it just certain kinds of turbines? Like what do you hear about that issue?
Yeah, absolutely. It's really been across the board. I think, as we think about CCGTs and peakers, it hasn't necessarily been focused on one area or the other. It's all kind of large scale turbines that we have heard from, a number of different suppliers, that if you are deciding today that you want to build a new gas plant, you'd be lucky to get a slot towards the end of 2028, and more likely you'd be looking at getting a slot for something that could come online in the 2029 timeframe. And so as we think about some of these large load consumers of power, that are trying to strike these deals with power producers today, I think that's part of the reason that it's taking a bit longer than a lot of people thought to see a lot of these deals come to market, where we've only really probably seen two, and they've both been on the nuclear side of the equation. We haven't seen much gas actually inked yet from a deal perspective. So that's part of why we think renewables will be a helpful bridge solution there. But when we look at the regulated utility side, I think this is also a place where they can lend sort of their expertise as slower moving companies that tend to plan really far in advance. Throughout earnings season, we've seen a number of utilities increase the share of generation CapEx in their 5-year plans. And a lot of that is going towards now more traditional generation like gas. Take a company like Duke, for example, that highlighted on their 4Q earnings results that I think they're bringing on something like 5 gigawatts of gas by 2029. And they've got all of the turbines already secured for all of that 5 gigawatts to come online by 2029. But this is a company that is planning 5 years in advance and not deciding today that they want a new facility. So I think we've seen, really, whether it's supply chain on the generation side with the gas turbines, or even other areas of the supply chain, like for transformers or switch gears or other sort of grid equipment, a lot of the utilities have seen the supply chains shift over the last couple of years, and they've started to procure much further out in their timeframes than they may have historically. So historically, I think a lot of companies would have planned, call it 2 years in advance. And now a lot of the utilities that we speak with are already procuring equipment out, 3 to 5 years, to make sure that they are able to execute on these long dated plans and some of the shifts that we're expecting to see from a secular perspective around the inflection in power demand. So it's something that we think we'll need sort of a bridge solution for, but we do think it's an area that will make the regulated utilities potentially more attractive to some of these large load customers that are looking on where to locate their facilities, because a lot of these companies have already planned to bring on a lot of generation.
So one question, Carly, it comes up so much, is that we're all watching the tech companies and what they announce next, right? Like, we're building this facility here, we're doing this JV here, we've invested in this nuclear company here. You're just kind of watching, and of course you're watching their CapEx is now so significant around all these things. And I think the other impression we have is that the tech companies' strong desire to have a certain kind of power is always driving this. One, reliable, but two, low impact. And sometimes it feels like they're just slowly working their way to saying natural gas is fine. I don't have to have everything else, all the other bells and whistles. But what would you say about tech attitudes towards source and type of power, and how that affects all this analysis?
Yeah, it's a great point, and it's definitely something that we've seen evolve, I think, as we started to do more work on data centers in particular, where when we first started looking at this theme, early last year, it was reliability and it was clean power that were the top priorities. And I think that was part of why when we came to our estimates on the type of generation capacity that would be added to fuel this demand, we assumed a mix of 60% natural gas, 40% renewables for new build capacity to try to balance out those two elements of these facilities have a specific reliability requirement, but these companies are also very committed to their public, sustainability targets, some specifically for power consumption. But then as we've seen this sort of evolve, we've seen a shift in the top priority, and that has now moved to time to market versus generation type. Now, I think there is still, to your point, there is a thought process around a preference to have clean, reliable power. That's why we've seen so much focus on nuclear, and so much talk about, these co-location debates in places like PJM, with where a lot of these large nuclear plants are located, to try to get those deals across the finish line. But I do think we've seen a shift to it's just time to market, and we'll kind of take what we can get. Now, does that mean that you'll see the same flashy announcement come out about, we're signing this deal, with, take, for example, the Constellation Microsoft deal? Will you see a big flashy announcement like that if you have a natural gas fired, plant that's going to be built to support a data center? Probably not. There may be requirements from some of these customers that they want to try to keep that separate, to not make it, optically look like there's so many fossil fuels that are being used to fuel these data centers. But I think it really has been time to market, at least for, initial kind of ramp periods. And then maybe down the line, there's an opportunity to build more renewables to satiate that demand. But in the near term, I think we would certainly expect to see more of an opportunity on the gas front.
So Neil, you said something in the upfront that really caught our ear, which is you commented on management quality or management reputation. You commented on this factor, and how are investors figuring that factor out? You've seen this for a long time, since you joined Goldman in 2008. But how are investors really zeroing in on that amorphous but also important variable in the equation?
It's really hard to figure out the pulse of, what drives an investor perception of what is management quality. But it's one of those things, you know it when you see it. And so I think there are a couple of components that investors are focused on. Of course, the easiest one to look at is total shareholder return. And so if a company has consistently delivered strong total shareholder return, not over a 1-year period, but over a 3, 5, and 10-year period relative to the peer set, that's usually a starting point. But then also, if a company is consistently underperforming, what are the actions that the board is taking to correct that, to demonstrate that the board truly is a fiduciary of the shareholder? And so I think often the tension that exists, and when you've seen some of these activist situations emerge, it is when a stock has consistently underperformed, Maynard, and it doesn't appear that the board is being proactive in addressing it and in developing a plan to steady the ship. And so I think that is what creates what investors want to see when you see underperformance on total shareholder return is a deep understanding of the root cause of the problem. And the second is a strategy to treat the illness, if we want to use that, the analogy of being a doctor, right? And it doesn't mean that the treatment has to work, because you can't control what you can't control. But it does mean that you need to have a proactive plan. To be reactive and expect the market to come to you can work in a short period of time. But if it's a sustained problem, what is the corrective action? So I think that is one component. Another component is when we think about ESG, the conversation has evolved. But being a good steward of safety is incredibly important. When you think about BP and some of the challenges that we've outlined here, in my career, we've seen Texas City, Prudhoe Bay, of course, Macondo, major explosion at refineries recently in places like Toledo. Two CEOs that have transitioned, right? That's a good example of where the market is saying there's something that needs to be improved from a safety and governance perspective. And it's been a huge focus, including for Suncor. That was another area where, Maynard, that received a lot of focus, where you had 14 fatalities at Suncor facilities, a lot of them of contractors. And so total shareholder return is one thing that I think the market is very focused on in terms of management excellence. Safety and operational excellence is another area. And the third area is depth. So I think when we talk to a lot of CEOs, they're always surprised at how focused investors are, not just on 1, 2, and 3. Of course, we care about who the CEO, COO, and CFO are, but who are 4 through 10 in the organization. And the market has a very sophisticated understanding of depth of management team, because one of the key risks is concentration risk, where if there is an issue at the top and there's a transition out, who is a logical person to then step into that role? And so I think management succession is the third area, I think, of the way the market perceives management excellence. So our message, and I know so many of our CEOs listen to this, and our best piece of advice of observing this sector over the last 2 decades is focus on how do I drive long-term shareholder return? How do I ensure that I am prioritizing safety and operational excellence? And how do I demonstrate to the market that I have a credible, thoughtful plan about the way I think about the depth of my management team? And how do I introduce not just 1, 2, and 3, but 4 through 10 of the organization to highlight that depth to the investment community?
That's very good, very thoughtful, Neil. No surprise, good thoughts. But you said one thing I just want to touch on before we, Carly, grab you and talk about power prices. We got to talk about power prices. There was a trend for a while, Neil, and I won't describe this quite right, but generally speaking, where investors were looking for more access to the board. Hey, can I see your lead director? Can I meet with your chairman? Can I meet with, I don't know, any of them? Like, to this point you were raising around boards, is that a trend that still has momentum as far as you can tell, or is that settled out, or is there a way moving away from that? Like, where is that discussion?
That's incredibly important, especially in situations where there has been share price underperformance. I think when the 3 parameters we were talking about, the most important of which is financial returns and total shareholder returns, are tracking well, I don't think the top 20 shareholders that we work with as our clients are going to be clamoring to meet with the boards. But when you have sustained underperformance, or you have operational issues, or there are concerns about succession, I do think making the board available so there is a direct communication between the investors, the owners of the company, and that board is incredibly important. To use management as a way of filtering the message from the investors to the board, it's kind of like playing a game of telephone. You'll probably get most of it, but there are parts of it that you won't get. And there are parts of it that the investment community will be less willing to talk directly to the management teams about. And I do think that is important. So I do encourage all of our companies to be actively engaged between the board and their largest shareholders. Now, the context of those board engagements over the last 5 years was a lot of that was about developing your low carbon strategy and your ESG, specifically the environmental strategy. As ESG is evolving to be broader, I think the conversation should really be focused on making sure that you're driving optimal shareholder returns, management depth, and operational excellence.
Would you advise a company, let's say they did an analyst day, have your chairman or your lead director or a couple other board members come? I don't know if that's common practice or not, but is that something you think is a good idea?
The board should be present. The board should be engaged. And in some of the best companies that we work with are are the ones who make their board very visible and focused on driving shareholder return. And so the boards matter a lot, and we want to see boards that are engaged and who are completely aligned with investors in wanting to be at the top of the leaderboard on a 1, 3, 5, and 10-year basis.
Carly, I got to ask the question that's on Mike's mind, my mind, everyone's mind, which is the way in which power prices have just been going up, right? And it doesn't really matter where you are. Sometimes the prices are better, but they're still going up. The trend feels up. And I wonder, in your world, maybe talk to us about the pressure that creates, to say we're going to have the next customer, or we're going to, add the next amount of CapEx to our rate base and the implications there. Like, maybe just talk to us about the pressure or competition around power prices and how that shows up in your world.
Yeah, absolutely. It's a great question and something we've been thinking a lot about. I mean, it's been interesting to see, the front of the curves have, to your point, been moving higher on power prices across a number of different regions. But we haven't seen the backs move, all that much when we think about the context of the immense shift in power demand that we're expecting to see. Whether that's in PJM or it's in ERCOT, if we look out towards, the 27, 28 parts of, the curves, prices are still probably in a $55 to $60 per megawatt hour type of range, which is higher than it has been over the last couple of years, right? But it's not $80, or it's not a place where we've seen some of these PPA, prices, PPA contracts signed for new large load customers. Or, we've obviously only seen nuclear deals signed so far, but even when, we've talked to corporates on where potentially these contracts could be signed for gas deals, for example, as we were talking about before, it still seems to be in that, maybe $80 per megawatt hour range is the expectation for where those contracts will be set. So relative to where the back ends of the curve are, we haven't really seen that step change higher that would account for the significant shift in the demand environment that we're expecting to see. So when we look across some of the companies that we cover that have exposure to these markets, we don't really have a significant escalation in power prices as we get out over the next couple of years. I mean, in PJM, when we look at a company like PEG, that we cover in that market, we continue to assume prices in kind of this $50-ish per megawatt hour range over the next couple of years, continuing to assume capacity prices stay elevated in that market because of the need for more new build generation there. But I think it certainly is perplexing to a lot of people who look at this, that we haven't seen the backs rally as much. We obviously know that there's not as much liquidity out there in the curve, which can be an issue. But I think when we talk to especially the companies that operate in ERCOT, I think the view is that the curves have not yet actually reflected the load growth that we're expecting to see, especially in a market like ERCOT, where these large load queues just continue to grow. And we look at the CDR, and when you capacity adjust these renewables that are coming online, the markets look really tight from a supply demand perspective. And even the NERC, reserve margins that came out at the end of last year showed much tighter ERCOT reserves than they had modeled in their previous report. So I don't think that we've seen really the full move of the backs of the curves on the power price side. But I think the expectation still is that if you're signing a PPA, you're going to be getting something that is well above current power curves.
Yeah, Carly, I think in our preview, we talked about utilities being growth stocks. And, here at Veritone, we've been talking about that for the last 12 to 18 months, that they are growth stocks and they've done very well in general. However, I go back and put my hedge fund manager, hat on here, back when we were doing gas and energy companies. Back in basically the shale revolution, the big growth stocks were midstream companies, right? And they massively underperformed because they did a lot of dilutive equity, just a lot of LP structure, stuff of that nature. And the reason I mention that is that, and during that time frame, the utility companies outperforming. So a lot of these investors that are in pipelines and utility companies are one and the same type of investor. And so when I think about the growth going forward, it almost seems very similar to me, where the growth that's going to be experienced in the utility world over the next 3, 4, 5 years is massive. And so what I worry about is investors now are saying, okay, there's going to be a lot of equity that needs to be issued to fund this growth, because it seems like every quarter it goes up 10, 20, 30%, the outlook. Maybe describe, is that an issue that utility investors are thinking about right now? It seems like a lot of equity capital is going to be up front and all the utility-based growth is going to be on the back end. How are you thinking about that? How are investors thinking about that?
Yeah, we've definitely been thinking a lot about that. Maybe first, let me just put kind of the growth point that you're highlighting into context. When we look at just our coverage over the last 10 years, most of the stocks have grown earnings by 3 to 5% per year on average. When we look over the next 4 years or so, we see our coverage growing earnings by about 8% on average per year, with some stocks growing 10%. So we would certainly agree with you that there is a shift in the growth outlook for these stocks that is not going to come without equity. To your point, we saw it this earnings season, nearly everybody added incremental equity to their plan. I think the right ballpark is likely 30 to 50% of any incremental equity or any incremental capital coming to the plan is going to be funded with equity. There's also going to be a lot of debt issued. But I think what we've seen thus far is that if you can tie the equity back to specific still earnings accretive growth opportunities, then that is something that the market will absorb. If you're coming at it from a different angle and, it's not earnings accretive, or you're pulling yourself out of a balance sheet hole, or there's something else going on, there will be potentially more skepticism from the market to absorb that equity. But I think as we look across our coverage now, we probably see about $800 million to $1 billion of equity per year for our coverage to fund these capital plans, which, as we update after 4Q earnings, we now see 2024 to 2027 CapEx for our coverage up nearly 50% versus what they spent in 2020 to 2023. And so, we still think that that's a fairly appropriate amount of equity for that much of a capital increase. And I think the commentary from most companies on earnings calls was, we're massively increasing the capital plan. We are adding some equity, but we're probably still going to grow at least towards the top end of our guidance range as we look over the 5-year planning period. So I think as long as that tie to still earnings accretive growth is there, the market will likely absorb it. The only other piece too is just we have seen a little bit of a shift, I guess, in preference in terms of the methodology for that equity. Most companies are still have a preference for doing this through an ATM where possible. So doing it in a ratable way. There's a couple of companies that have come out and done blocks or done forward sales to try to pre-fund some of that growth that they're expecting to see. And we're also seeing more focus on hybrid type instruments like JSNs, that you're still getting some of the, equity credit from the agencies. So the balance sheets are very much still top of mind. So we'd expect to see a little bit more activity on that front to fund this growth as well.
Well, we often say this because we're blessed to have great guests. It's hard to stop talking. We have to. It's terrible to let you guys go. This is so great. Can I ask you both two 1-minute questions to round this out?
That's great.
Carly, I was thinking when you were talking about the power forward curve, it just seems like forward curves my whole life. They've just caused nothing but confusion because, it never seems to really represent the price. That's the only thing but yet it's always on people's mind, and it's a reason. There's a good analytical reason to use it. The power forward curve. You mentioned it's illiquid. Is it, what is the usefulness of it, right? Because I was thinking if I'm a utility, when I get out there, right, I'm just going to be passing through the cost of power, right? Like I'm not necessarily waking up every day, I think, worried about hedging that exposure. Like the usefulness of the powered forward curve, is there anything you could just tell us about that analytically and why we should think it matters as much as it seems to?
Yeah, I mean, I think Maynard, you hit on it, which is that it's kind of the only marker that we have, and it's still what I think what a lot of investors will dial in to their models. And so it's good to have a pulse on what the kind of consensus is that's driving earnings estimates. I mean, even some of the IPPs run the forwards through their earnings guidance.
Yeah.
And so I don't think you see a whole lot of people out there. I think a lot of people do anchor to it. And so I think just to get a pulse on kind of what the consensus is, I think it is still, to your point, a useful sort of modeling tool. And then if you want to make a call on, the curve is wildly off, that probably drives your estimates well above or below consensus. But I think it is a good anchor point just to kind of what a lot of people are analytically using in their models.
Okay, Neil, I'm closing with you, big fella. It is your birthday. Happy birthday. How much fun you're spending it with us. We can't believe it.
It's a great pleasure.
This is so fun. Question for you. I think you mentioned this dispersion up front, and Carly, you mentioned it in your universe here of all the stocks you guys cover. Some of the worst ones are down 15+%. Some of the best ones are up 20 something. So there's a wide dispersion. What's your advice, Neil or Carly, on, so you got an earnings call coming, it is what it is in terms of the substance of what happened, but how do you make it a good earnings call otherwise? Meaning, how do you address the problem right up front? How do you take bad news and, I guess lemons and turn them into lemonade? Like, what is your advice around the soft stuff that could help companies manage some of these tough quarters?
It's about keeping your eyes on the horizon. So even if there's some short-termism on the near-term quarter, help people remind people the 3 reasons they should buy your stock over the next 1 year, 3 years, and 5 years. And to the extent you can provide visibility, I think it goes a very, very long way. So give us that long-term cash flow number, long-term earnings number, and keep on driving back to that.
Awesome. Carly, anything you'd add to that?
I think Neil hit the nail on the head. I think acknowledging what some of the short-term issues might be. The plan of action, I think, as Neil alluded to before, in terms of his comments on management quality, define the action plan, and then give us that long-term view and how you plan to get there.
This was awesome. We may have just created a new tradition, grabbing you guys at the end of the quarter, but we won't be greedy. Carly, thank you so much. We appreciate Neil as well, and appreciate everybody at Goldman, all the work you're doing.
Thanks so much. Appreciate the time.
Thanks, everybody.